Hello students, as you know that in this pandemic situation the government has issued an instruction to work from home, and to motivate the students, this is my first lecture which I am going to upload on the website. So there may be a slip of time, so consider that. Study at home, study safely, focus on study. Okay, let's begin that. Hello students, as I told you that we are going to start classes online. So today we are going to conduct very first lecture. As you know that we have already displayed, this book is available in the market, and this ebook is already sent to you on the group. So let us start and begin with very first session of e-learning chapter 1. In today's lecture we are going to cover the definition of business, sole trading concern and partnership firm. So before starting that, let me explain you what is a business. As we know that the business is the activity of providing goods and services involving industrial aspect, social aspect and financial aspects. So goods means we are providing a goods to a needy person. That's a business, and we have already learned this chapter in 11th that what is business. So we have different types of business like sole trading concern, partnership firm and joint stock company. As far as sole trading concern, we have certain limitations in that. That limitation is we have a limited capital, we have a limited skills, we have limited managerial skills. So whole responsibility of the business is on the shoulder of the single person. So it's quite difficult to enhance the business, and due to this lack of problems, the partnership has introduced. So our first chapter is partnership final account. So we are going to start introduction to partnership final account. So before starting, let me explain you what is a partnership firm. As per the Act 1932, Section 4, the partnership is defined when two or more persons coming together to start a business and their objective is sharing profit and losses is called a partnership firm. So it is very clear, when we want to start a partnership firm, at least there must be a two person to start this kind of business. So that is partnership firm. Maximum number is 50 as per the Companies Act 2013, which is amended in the year 2014. So earlier we are using the Partnership Act 1932. In that we studied that minimum 2, maximum 20, and in case of banking business we required a 10%. But as per the Companies Act 2013, we can extend up to 50% in a partnership firm. So 2 members minimum and maximum 50 members as per Companies Act 2013. So this is a business where 2 or more person are coming together to share profit and losses of the business. Students, as we have seen, when you will open the government textbook on page number 2, there are 9 features given of the partnership firm. The very first feature is the agreement. So there must be an agreement among the partners, and this agreement may be oral or written. Sometimes it may be asked in the examination which agreement is applicable. Both are applicable, either it may be a written or it may be oral, but written agreement may stand in the court of law. So it is always preferable to use a written agreement. The second feature of the partnership is that there must be a minimum 2 number of persons should be there to form a partnership. So 2 or more, up to 50% you can add in the partnership firm. And as per the Companies Act 2013, we can join 50% into the partnership firm, which is amended in the year 2014. Third feature of the partnership is that a lawful business. Lawful business means the business which the firm is going to start, the partnership firm is going to start, must be a lawful business. which is permitted by the state government, which is permitted by the local authorities like the municipal corporation of the Aurangabad. Likewise, whatever authorities are there, they should be permitted to your business. So it should be permitted by the local authorities, it should be permitted by the government of Maharashtra, it should be permitted by the central government, that business can start by the partnership form, which is a third point. Fourth point is sharing of profit and losses. Remember student, profit and loss is the main objective of the business. As we know that every business is having its own objective. The purpose of the business formation is to maximize the profit or to maximize the assets. So here the profit and losses should be shared equally if the partnership deed is silent. If the partners are agreed to share their profit of the business on a certain percentage that they have to mention in the agreement, then only they can share as per their ratio. As an example, there are three partners A, B, C, and they contributed equally capital, as an example 2 lakhs each. So total capital of the firm is 6 lakh. If they earn a profit of rupees 60,000, if it is mentioned in the partnership agreement, they will share in 2:1 ratio, then they will share in this ratio, otherwise they have to share equally in absence of the ratio. Understood? Now the point number 4 is over. Now point number 5, unlimited liability. It's a very important, sometime it may be asked in the objectives as well. Unlimited liability means the liability of the partners is unlimited. If he is unable to pay the debt of the business, his personal property can be sold out to repay the debt of the business. Understood? What if the person or the partner is unable to pay his debt, then his personal property can be sold out to repay the debt amount. Even as an example, A, B, C are three partners and A has become insolvent. In that case, the B and C will pay his amount of debt as a partner. So here the limit liability of the partners are unlimited. Point number 6, registration of the firm. We have to register firm as per the Maharashtra Act. In Maharashtra, whenever a partnership firm you want to start, you have to register it. In some state, it is not compulsory or mandatory to register the partnership firm. Sometimes we may have a small business, as in construction business, there may be 2-3 persons come, they can start with a oral agreement and they can continue the business because the duration of the business is very short. As an example, they want to construct a building, so they have just joined for a joint venture. In that case, it's not compulsory among the partners to register it. But if the large scale business are there, so in that case, the partners have to register their firm as per the Partnership Act 1932. Point number 7, joint ownership and management. Point number 7 is what? Joint ownership and management. In that case, each partner is severally liable for each action of the business. Among themselves, they are the agents. As far as the outsiders are concerned, they are the principal. They act as a principal on behalf of their business. So the ownership and the management is joint and several. It means anyone out of them can act on behalf of all. It is not necessary if there are 3 partners, so all should act. Only one may be act to he may be act or deal with the outsiders, so it will be considered on behalf of that firm. Point number 8, principal and agent. And the last point is a dissolution. If the partnership they want to dissolve, it's a very simple process. The partner has to give in writing a 14 days prior notice that I don't want to continue this business. So after that 14 days, the firm may be dissolved. So these are the all features of the partnership firm. Now, very important point in the partnership firm is partnership deed, partnership agreement or partnership contract. partnership agreement or deed is nothing but all details related to partnership is written in that agreement. It's a official paper or it's a bond where related to partners all the details are noted. Very first thing, the name and address of the firm. Second, the name and address of the partners. Third, the capital contributed by the partner. Fourth, ratio in which they will share their profit and losses. Fifth, the liabilities of the partner, what role which partner will play is written over there. Next point is provision related to admission, retirement and death of partner. Suppose there is some admission they need, so what the terms and condition will be there. If some partner is going to retirement is taking retirement, in that case what the provisions are there, all these are written in that partnership agreement. And point number 8 is that the rate of interest. Suppose one partner is contributing additional capital, in that case what rate of interest will be paid to him. If suppose some partner is taking out some amount from the business, in that case in form of drawing, in that case what the rate of interest will be charged is written over there. Point number 9 is salary, commission. If salary or commission, if payable to the partners, at what rate you will pay commission or salary to the partnership in the partnership firm to the partners. Remember student, it is not allowed in partnership to pay any kind of salary or remuneration or commission to the partner, but if it is written in that, so in that case we have to pay according to the written rate or written agreement. And point number 10 is settlement of the accounts of dissolution. If suppose the firm is going to dissolve, in that case how you will settle the books of account, that you have to write in that. Or last point, any other matter related with the partnership will be mentioned in the partnership agreement or partnership deed. So remember student, the partnership deed or partnership agreement is very important. While you are studying, please make a note of this partnership deed. Somewhere it is asked for 1 or 2 marks in objectives. In partnership final account, generally partners are maintained via 2 types. First is fixed capital method, second is fluctuating capital method. So first understand what is the fixed capital method. Under this method, the partner's capital is fixed. There will be no change in the partner's capital account. Whatever entry related to partners, as an example salary, commission, dividend or anything related with the partners will be recorded in partner's current account. So in method we have fixed method. In that we have to open 2 different accounts. First account, partner's capital account. In that the capital contributed by the partners will be recorded on the credit side. It is in columnar form, as we already studied that. As you know that the format is given in that. So according to that we have to credit partner's capital account and just close down that. And second account which we have to open under the fixed method of account, that is partner's current account. Now in this account, whatever entries related with the partners, means as we have seen the partnership deed, in that if suppose we are paying the salary, so we have to credit to the partner's capital account. If he is getting some commission, we have to credit to partner's capital account. Means whatever entries are related with the partners will be recorded in partner's current account. So understood? In fixed method we have to open 2 accounts. Now the second method, which is fluctuating method. Method number 2, fluctuating method. Under this method, all the entries related to partners, and as an example we have 3 partners A, B, C. So whatever entries pertaining or related to the partners A, B, C will be recorded in 1 account only. And the name of the account is partner's capital account. There is no need to operate separate partner's current account, as we have seen in the first method. In second method, just we have to open the partner's capital account and all the entries related with the partners will be recorded into 1 account only. So here in the fluctuating method we have only 1 account, but in case of the fixed method we have 2 accounts, partner's capital account and partner's current account. Here we have only 1 account in fluctuating method, that is partner's capital account, and whatever entry related with the partners will be recorded in that account only. So students, before starting the final account, we understood what is the meaning of the partnership firm. We know the definition of the partnership. We understood the partnership deed, and we know the methods of account. These 4 things we have learned. We try to understand. Okay, the details are in the book, which is already available with you in form of ebook. Now, in final account, what account we have to maintain? In final account, generally we have to prepare 3 different account, 2 different account and 1 statement, which is called the balance sheet. The very first account is the trading or manufacturing account. Second is the profit and loss account, and third, which we have to prepare and maintain, which is a statement, not an account, which is a balance sheet. So first understand what is the trading account. The format is given, but I am just briefing you what is the trading account. Trading account is an account which is a type of nominal account, and all the direct expenses and direct income are recorded in the trading account. Clear? What we are recording in the trading account? In trading account, we are recording all the direct expenses on the debit side of trading account and all the direct income on the credit side of trading account. Okay, what is the direct expenses? The direct expenses which are related with the manufacturing expenses. So generally in companies, they maintain a trading account or they maintain the manufacturing account. So whatever direct expenditure incurred, that we have to record on the debit side of trading account. As an example, opening stock, purchases, wages, factory expenses, freight, royalties, etc. These are the direct example of the direct expenses that we have to record on the debit side of trading account. And we have only one direct income, which is we are receiving by way of sales. So on the credit side of the trading account, we have to record sales and entries related with stock. Remember student, on the credit side we have to record only 2 things. First, direct income, which by means of sale, and second, entries related with stock, means closing stock, good destroyed by fire, or given as a free sample. So related with the stock on the credit side. Now some students may get confused, what is the direct expenditure, what is the indirect expenditure. So direct expenditure is that expenditure which is incurred to convert a raw material into finished goods. So whatever expenditure is incurred while we purchasing the raw material, we have paid overhead charges, we have paid the factory rent, we have paid the factory electricity, we have paid the work manager salary on the factory. So up to convert of the finished goods, whatever expenditures is incurred, that expenditure is called a direct expenditure. In simple term, when you purchase a raw material and giving it to and converting it to finished goods, till that whatever expenditure is incurred, that all expenditure we have to consider as a direct expenditure, and when it is a direct expenditure, we have to record it on the debit side of trading account. Is it clear? Now coming on the second account, which is a profit and loss account. Generally, profit and loss account is a nominal account, and while we practicing this, we are preparing trading account and profit and loss account combined. In book, somewhere it is given as separate, or we can combine it, no problem. But on the trading account, we have to record direct expenditure. On the profit and loss account, we have to record indirect expenditure. So what is the indirect expenditure? The expenditure which is incurred at office, at a retail outlet. In a simple example, as an example, a businessman is having a shop, a retail outlet somewhere in the city. So whatever expenditure is incurring in that shop, so that expenditure is called indirect expenditure. As an example, salaries to the employees. As an example, office rent. As an example, light bill, mobile bill, administrative expenses, general expenses, audit expenses. All this expenditure is called indirect expenditure that we have to record on the debit side of profit and loss account. On the credit side, again the credit side is the income side. Whatever indirect expenditure is receiving the business, that we have to record on the credit side of the profit and loss account. As an example, as far as in the book is given, there are only 5 incomes which are indirect in nature: rent received, commission received, dividend received, miscellaneous received, or any profit in the business which is in indirect form. So all this we have to record on the credit side of profit and loss account. Now we understood what is the trading account. Now we understood what is profit and loss account. The purpose of this account to find out the gross profit at the trading account and net profit in the profit and loss account. Sometime it may be asked in the examination the purpose of the trading account. So you should be very clear that the purpose of the trading account is to find out the gross result of the business. What is the gross result? Either a gross profit or gross loss. The purpose of the profit and loss account is to find out the net result of the business. Net result, net profit or net loss. If the credit side is more, so we are getting the profit. If the debit expenditure side is more, so the business suffering from the losses. So we have to take this balance into balance sheet or partner's capital account. Now hereafter, as we have to prepare another account, which is partner's capital account or partner's current account, which we have already discussed. Sometime the student may confuse when to open current account, when to open partner's capital account, and how to identify which method is given in the problem. It's a problem based question. So when the current account is given in trial balance, it means the method is fixed. And when the method is fixed, in that case, we have to open 2 different accounts. One partner's capital account and partner's current account. And entries related with, we have to transfer to these 2 respective accounts. When the method is fluctuating, when all the entries related with partners, combining this entry will be recorded in the partner's capital account, and we have to close this partner's capital account. We will arrive somewhere profit or loss. This profit and loss will be transferred to balance sheet. If the profit, it will be shown on the liability side. If it is a loss, we have to deduct it from the capital. Now the last point is the balance sheet. The balance sheet is not an account, it is a statement. The statement is showing the financial position of a business on a particular day. Left hand side is a liability side and right hand side is the assets. So all the assets are recorded on the right hand side. As an example, it's having a hierarchy: the fixed asset, then current asset, then contingent asset. On the left hand side we have the capital, then other liabilities, third party liabilities, bank loan, and the current liabilities are recorded. So balance sheet is not an account, is a statement which showing the financial position of a business on a particular day or date. Now students, we have to consider the formats which is given in the book on page number 16, the format of the trading account. On the trading account, we have it is started on debit side with opening stock, then add purchases. If there is some return, we have to minus return, then carriage inward, freight, duct charges, custom duty, wages and product, manufacturing wages, wages and salary, import to coal, gas, motive power, oil, water charges, to royalties, pre-primary packing charges, factory lighting, heating, factory rent and rates, factory insurance, work manager salary, gross profit carried down. If suppose the debit side is the credit side is more, the difference will be recorded on the debit side as a gross profit. Now coming on the credit side, have a look there on the page number 16. By sales less return inward, if there are some return, we have to deduct it. Then goods lost by fire, goods lost by theft, good distributed as free sample, goods lost in accident, goods withdrawn by the proprietor, then closing stock. As I told you in the format, On the credit side, we have only two items. One is direct income, which is sale, and secondly related with the goods. And we know the purpose of this profit trading account. Now coming on the profit and loss account format. Page number 17, government textbook. Have a look on the debit side. You will find the very first item which is written at the top is salaries. Then salaries and wages. I will explain you what is wages and salary and wages. To rent and rates, to insurance, to electricity, lighting, telephone and postage, printing and stationery, traveling expenses, depreciation on fixed assets, loading charges, audit fees, entertainment expenses, repair and maintenance, interest on loan, sundry expenses, miscellaneous expenses, conveyance, loss by fire, loss by theft, loss in accident, good distributed, for example, common commission allowed, discount allowed, allowances, advertisement, carriage outward, sales charges, bad debts, export, taxes, general expenses, trade expenses, legal charges, professional charges, bank charges, solicitors fees, secondary packages, expenses, loss on sale of fixed asset, net profit transferred to partners, capital or current account as per the method. Coming on the credit side, have a look on the credit side. Very first item, which is gross profit brought down. If you arrive at a gross profit in the trading account, that will be considered here. Then commission received, discount received or earned, interest received, dividend received, rent received, miscellaneous received, profit on sale of asset, net loss transferred to partners, capital or current account. Suppose the debit side of the pre-P&L account is more, so we have a loss and that will be transferred to partners capital account. One more instruction for you student, that you have to write this format in your notebook, page number 16 and 17. Student, open page number 18 of your government textbook. In that, the format of balance sheet is given. On the left hand side, the liability is written. As I told you, on the liability side we have a capital. The example of the partners are given ABC, so we have to take these balances from the partners capital account or partners current account. Then partners current account, the method is fixed. In that case, we have to open the partners current account, otherwise there will be only one account on the liability side, that is partners capital account, and the method is fluctuating. The next item is given general reserve, profit and loss account, loan on mortgage, bank loan, loan from the partners, bills payable, bank overdraft, sundry creditors, provision for discount on creditors, outstanding expenses, income received in advance, provision for taxes. Now coming on the asset side, as I told you, there is a structure or hierarchy. While we are recording at the top on the asset side, we have to record fixed asset, then current asset, then contingent asset. The very first item which is written on the balance sheet asset side is a goodwill. Now coming on the balance sheet asset side, very first item which is appear on the balance sheet asset side is a goodwill. Goodwill is nothing but the reputation of the business. Then the building, if there is some depreciation, we have to deduct that amount of depreciation by calculating. Then we have premises and depreciation, loose and tools depreciation, sports material depreciation, outstanding income, loans and advances, closing stock, debtors. On debtors we have adjustments like bad debts, new bad debts, provision for bad debts, then insurance claim, receivable, bills receivable, cash in hand, cash at bank, partners current account if the balance is credit balance, that we have to record on the balance sheet asset side. Students, now we try to understand what is the trading account, what is the profit and loss account, and what is balance sheet. The format is given in the book. Your duty is what? You have to write down all the items make neat clean format in notebook. If you do not understand any word or terms of the formats, then you can ask me, I will explain it thoroughly. As far as the trading account is concerned, we understood the purpose of the trading account is to know the gross result of the business, either a gross profit or gross loss. The purpose of the profit and loss account is to know the net result of the business, net profit or net loss. From here after, we have to transfer this to partners capital account or partners current account, and by closing the partners capital or current account, we have to prepare a balance sheet, and balance sheet is nothing but the statement. On the left hand side we have a liability, on the asset side we have all the assets. The goodwill is there. How many of you know the goodwill? We studied in the 11th. The goodwill is the reputation of the business. So it's coming in the intangible assets, which we cannot touch and see. It's an intangible asset. So all the assets we have to record on the balance sheet asset side, and after transferring this, we have to make a total of the left hand side and right hand side. If it is got tallied, it means we have solved the problem correctly. Now your duty is what? You have to read this chapter. If you have any difficulty, we will discuss while we are using the Zoom app. Thank you. Best of luck for your study.